What's going on YouTube? It's GanMO. Today, we're going to be telling you how many rental properties you need to own in order to put down that stethoscope, or in our case, the drill.
But keep that mask on.
Yes, keep that mask on. Let's get started.
So rental properties are a great way to supplement some or all of your retirement needs. Now the great thing about rental properties is that it produces a steady stream of income without having to tap into your actual principal. And they also come with some great tax benefits as well. So before you embark on your real estate investing journey, you need to understand that investing in real estate could be a very tedious process. It has a lot of ups and downs, and for the lack of better words, it could be an emotional roller coaster. Now, just like every journey has a destination, our destination here is the number of rental properties we actually need so we can retire and finally put down that white coat and go play golf all day.
Call me if you need a caddy though. So healthcare professionals love doing math. So while planning for retirement, they like to use certain online tools such as Retirement Calculator, especially when they're investing in various assets such as stocks and mutual funds. But today, we're going to show you that the math you could do for rental income can be done on the back of a napkin. Now, real estate retirement math has three variables. Mo, break it down.
E, that stands for your expenses in retirement. Now, everybody is different. I might want to spend $100,000 in retirement. Gan wants to spend $500,000 in retirement.
A little less.
That number is really up to you to decide. And the second one is W, which is the amount of money you have to put into real estate. And the third one is R, which are your cash-on-cash returns on your real estate investing.
So all those variables put together create the formula W times R equals E. Call me the Albert Einstein of real estate investing.
So I know it sounds confusing, but let us kind of explain how that works. So let's play around with that formula. Let's assume that your expenses in retirement equate to $70,000 a year. And let's say that you're finding properties that will provide you a 10% cash-on-cash return, which means that you need to put into real estate a total of $700,000 to reach your desired income in retirement.
So say you want to spend a little bit more in retirement. Call it $100,000 per year. The equation stays the same, and you're able to find those rental properties that are providing you with a 10% cash-on-cash return. Now, you just have to invest $1 million into your rental properties instead of $700,000. The equation does not change.
So we're going to use some round numbers for easy math's sake, and I'm going to show you a recent fourplex I purchased for $360,000. And I put 25% down for that property, which came out to $90,000. And I got a 30-year fixed mortgage for the remaining principal balance of $270,000. So my total expenses, including my mortgage pay down, equates to $2,450 a month. The total rent income I receive per month is $3,800. And the total net operating income that I receive after expenses is $1,350 a month. And that is an 18% cash-on-cash return. And that doesn't even include my mortgage principal balance pay down. So when you're calculating your total cash-on-cash return and trying to figure out whether you should get a mortgage on that property or owning that property free and clear, stay away from properties that provide you with less than a 6% cash-on-cash return. And always be very conservative with your numbers. Never shoot too high or else you're going to fall short of your goals.
So now that you've calculated R and you know E, you can figure out for W. And you'll have all three variables. Remember, W times R equals E. So now let's see how all this ties into how many rental properties you need to retire comfortably. Let's say you want to live on $100,000 in retirement. And at a 10% cash-on-cash return, that equates to $1 million. Now you're able to find properties in the market for $100,000 and you purchase them free and clear. So now how does that work out? Well, $1 million divided by 100,000 per property equates to 10 properties. And let's assume you want to finance 50% of that $100,000 property. Well, now the math is a little bit different. 1 million divided by 50,000 equates to 20 properties. Now, is this a perfect prediction of your retirement rental income? Of course not. Things can change. Rate of returns can change. But remember, it doesn't need to be perfect. The key takeaway here is to move towards your financial goals.
But most importantly, we do hope that this video provided you with the information and a solid framework upon which you can build a successful real estate income in retirement.
Do you see real estate investing in your future? Let us know in the comments below. And don't forget to gingerly tap that subscribe button, and we'll see you next time.